QuickBooks Pro Desktop 2021. Multiple currencies, pay foreign, accounts payable. Let's get into it with Intuit's QuickBooks Pro 2021. Here we are in our multiple currencies practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we made a purchase of equipment on account, meaning we're going to pay for it at a future point in time, but we're also going to be paying for it in foreign currency. And so now we want to think about how we're actually going to pay it in that foreign currency. Then we also transferred money from our currency to the foreign currency so that we could pay off in foreign currency units. So let's take a look at it. We're going to go to the reports dropdown, company and financial. We're going to go on down to the balance sheet standard. Balance sheet standard, recapping the scenario by going to the customized reports up top, 01/01/21 to 12/31/21, and OK. Then we have the scenario. We purchased this piece of equipment here, and we purchased it on account, meaning we're going to pay for it in the future. Therefore, the other side went down here to accounts payable, double-clicking on the accounts payable. The original amount was on the books at the $41,600, even though we're going to be paying in foreign currency the amount of 400,000 yen, which was equivalent in US dollars at that point in time, given the current spot rate as of 8/30, the current exchange rate as of the point in time we purchased it, 41,600. Now, then we made an adjustment for an adjusting entry to increase the amount up to the 42,400 based on the spot rate as of 10/29, which is also the date that we're going to be actually paying the bill. We also went up top and we then made a transfer based on that information, taking money out of the US dollar checking account and actually physically converting it to $400,000 in yen, putting into the foreign currency bank account, which is holding 400,000 units of yen, which we are valuing on our financial statements because it's valued in US dollars as 42,400 equivalent US dollars. So we now have the 400,000 yen, which is 42,400 equivalent dollars as of the spot rate of this point in time that we're going to be making the payment of the 400,000 yen, which will pay off the accounts payable that we had when we purchased the equipment. Let's first think about this. One more thing to consider on this. If I go to the home page, notice that what we did was we entered the enter bill here, and we entered the bill, increasing the accounts payable. And then the next step would typically be in a normal process just to pay the bill. We would then pay the bill over here. And normally QuickBooks actually will then do the difference between the exchange rate, meaning it'll calculate the gain or loss without any interim kind of step in the middle. We did an adjusting entry in the middle. If we were just to enter these two transactions, it would then record the gain or loss for us. So for QuickBooks purposes, the adjustment that we did in the middle may still be necessary, but it would typically be necessary for different reasons than we're doing it in the Excel sheet, meaning it would be necessary for you to adjust the accounts payable, for us to adjust the accounts payable as of the month-end dates if it's still outstanding, so that when we issue the financial statements, the account payable is calculated as of the current spot rate for the point in time that we're making the financials. But if it did not go over the cutoff date, then we wouldn't need to do that interim step that we did over here to revalue the payable, because that calculation will be done automatically by the system when we pay the bill. Now, it's a little bit different over here when we think about it in journal entries. So in journal entries, we did that step for kind of a different reason. So we did the revaluation up top. So we put the accounts payable on the books here at the original spot rate amount. And then we did the revaluation here so that our accounts payable now is valued at the same dollar equivalent of the 400,000 that we have in the foreign currency units. And we can then match them out and pay them out directly. So in terms of a journal entry, what we would do now is we're just going to take the foreign currency units that we have and pay off the accounts payable. So the transaction is going to be fairly straightforward at this point. In terms of a journal entry, we're going to say, well, we're just going to pay off the payable like we normally would, which is going to decrease the payable, and we're going to pay it out of cash. It just so happens the cash isn't US dollars, but now is in foreign currency units. So we're going to do that transaction, similar transaction to paying off a payable that would look like in terms of debits and credits. The amount, though, is a little bit different because what we're paying really is 400,000 yen, which we converted to the US equivalent dollars as of the time of exchange, which is 0.106. So that's kind of the confusing part. You know, we're actually paying 400,000 yen. We're decreasing the accounts payable by 42,400 US equivalent value of the 400 yen that we're actually paying. So then if we pay this off, then we're going to double click on the accounts payable, and I'm going to say plus, and I'm going to say that this accounts payable here will take it down to 0, and then the 400,000 yen double clicking on the accounts payable here, or the foreign currency, and then that's the credit. It then goes down to 0. So now let's take a look at these two transactions. If I take a look at this one, I'm going to highlight it and make it green, and this one down below, these are the two transactions that we put together to basically value our accounts payable as of the same valuation that we're basically going to be paying in the current spot rate. Note that we could combine these two transactions together. In other words, we have a repeat account here for the accounts payable. So I could have basically made one transaction netting these two out, which would bring us back to the 41.6 item here, and do this with one transaction. That is in essence what QuickBooks will do for us. So if I go back on over to QuickBooks and I was just to say go from bill to payment, then I don't need that interim adjusting entry, because QuickBooks will use those two spot rates and basically combine these two together as if one transaction. Now this one in the middle we needed to do, of course, to simply transfer the money from our checking account to the foreign currency, unless we wanted to try to take it directly out of the one checking account. But in any case, we transferred money out of our dollars to the foreign currency yen. But these two accounts then will be done. You could be done with one transaction. So that means this kind of interim step here, we did this interim step for journal entry purposes, so that it makes it a little bit more clear what is happening from journal entry purposes. You may not need that interim step if you're not going over a cutoff date, meaning the month end or year end in QuickBooks. So you might still need this step, however. In other words, this middle step right here that we took, you might still need that step if you go over a cutoff date. So we entered it in place, which in our process might double up the change in the currency due to the different spot rates when we record the bill. And we wouldn't need to do that in QuickBooks unless there was a cutoff date at the end of the month or year, so that we needed to revalue our accounts payable to be reported properly as of the cutoff date. Just like with any other kind of adjusting entry, we would need to revalue at that point in time. Then the day after the cutoff, we might need to do then a reversing entry. So that means we might have the double up of that adjustment that we saw, the adjustment that results in a gain or loss due to the changes in the rates, and we'll deal with that in a future presentation. We'll see what the effects will be here. Now let's record this in the system. We're going to record the accounts payable, which will typically then be recording some type of decrease in the checking account. In our case, the checking account related to the foreign currency checking account. And then the other side would be decrease in the accounts payable. In our case, in this case, the accounts payable, which is the foreign currency accounts payable. Before going here, however, we would want to make sure that we have the proper exchange rate listed. So we go to the lists drop down and we go to the currency list, and then we're talking about the yen. Now, if it was in today's amounts, then, I mean, if we were doing this transaction today in real time, then we can download the current exchange rate, the spot rates as of today, by going to activities, download the latest. Now, because we are in a practice problem here, we're going to manually put it in place. So we're going to go in here and say that as of 10/29, we have the same date here. We're going to be picking up that 0.106. So when we put the accounts payable on the books, it was at 0.104. Now it's at 0.106. So I'm going to close this back out. Then we're going to go to the home page, and then let's go to the pay bills. So I'm going to go to pay bills, and I'm going to look for that bill that we want to pay. I want to go to the accounts payable for the Japanese yen. So we're going to the accounts payable for yen, focusing in on that account. We're going to check off the bill that we want to pay, which is going to be this item, 400 yen here, that we have to pay off, which is currently at the 42,400 in the US equivalents, given the 0.106 exchange rate that we just saw where it would be input. That looks correct according to our journal entries over here. So now we're going to basically write a check or assign the check number. We're going to assign the check number. Again, the check form is just the form that will be used to decrease the checking account. So it could be an electronic payment as well. This will basically be a transaction, or the form that will be used will be a check type form, the form that will be used in QuickBooks to decrease the checking account. In our case, the checking account for, we want the drop down, the Japanese yen. So selecting the default column, okay, I'm going to say okay. So there we have it. So we're taking it out of the Japanese yen account. So that looks good. Let's go ahead and pay the selected bill. Could have signed the check number. I'm just going to call it E3 and then okay. So we'll say okay. Let's check out what happens. I'm going to close this back out. We're going to go into the balance sheet then, and I'm going to go up top. Notice the checking account for the yen has now disappeared because it went back to 0. And then the other side for the accounts payable still has 800 in it. And that's what we're talking about this doubling up of the accounts payable for the 800 journal entry we made. So this journal entry we made here basically got doubled up. Why? Because what QuickBooks did is what we talked about here, recording these two transactions, netting out the two accounts payable for the bill. These two got netted out, and we entered this transaction in already, meaning we entered it twice. So we wouldn't need to enter this transaction unless we needed to do it for the cutoff purposes, meaning if I needed to do it on 1029 because I was running the financial statements then, and we had not, and I needed to revalue the accounts payable before we paid it, right? So now we'll have to deal with that being doubled up. We'll take a look at that more next time. Let's consider this more by looking at the trial balance, so we can see all the accounts. Go into the reports drop down, accounting and taxes, and the trial balance. So trial balance from 01/01/21 to 12/31/21, and then we can see the Japanese yen, it's going down, so we decreased it. We actually paid 400,000 yen in terms of yen dollars, yen, right? 400 units of yen, but the U.S. equivalent was 42,400 according to the spot rate at that point in time. Then we had the accounts payable that went down. The accounts payable still has that 800 in it, because we doubled it up, right? It got valued twice. So notice what was decreased was the 41.6, which again is netting out these two items here, netting out. And then a third account was affected during this transaction, that being the gain or loss account down here. The gain or loss for that 800, so you can see it also being doubled up. It got doubled up because we entered this in with a journal entry, and then it got repeated when we hit the pay bill. So once again, we wouldn't need this journal entry unless we were going over a cutoff period in here, because those two items those two journal entries are combined together. And so if we do need it, because there was a cutoff period, we'd need a reversing entry in order to remove it after the cutoff period had ended. So that's what we'll stop now, and then next time we'll do that reversing entry.